Unusual but intelligent ways of using a spread bet. Now in this short video, I'm going to be describing 3 unusual but intelligent ways of using spread betting to trade. The first way is the tax hedging strategy. Essentially, you utilize spread betting as a tax-efficient tool to convert your taxable profits at a futures broker into tax-free gains by taking an exactly opposite position with a spread bet. Second is the tilted index strategy. Having both long and short positions in your stock portfolio. With a 130 to 30 strategy, you are effectively 100% exposed to stocks. And the third is the hedging option. Another possible reason for using spread betting is to hedge an option position that is held for you in a quoted company. Now let's look at each of these strategies in a bit more detail. Tax hedging strategy. Use spread betting as a tax-efficient tool to convert your taxable profit at a futures broker into tax-free gains by taking an exactly opposite position with a spread bet. You can then exit both positions when the future moves against your position at the broker, and thereby the profits are transferred to the spread betting account. Now, of course, you will have to bear the cost of spreads on both sides, but that would amount to about 1%. There is a risk that your futures position will continue rising in value while your spread betting position continue losing value, but you would have to be really unlucky to get every bet right with a direct access broker and wrong at the spread betting provider. But of course, you could calculate a stop loss level as to when you would close down the spread betting positions contra future positions taxable value. Now, I know a couple of traders who have direct access and spread betting accounts and utilize this sort of hedging strategy. Tilted index strategy. Another way to trade would be to use the tilted index strategy. Let's suppose you're thinking of opening a £100,000 FTSE position. Then choose, say, the top 5 stocks you believe will underperform and open short positions in those stocks, and then open up long positions in the top 5 you think will outperform. If you're good, you get the beta of the index performance with the alpha of your own better than the market analysis. Mainstream pension funds and insurance companies, which were previously barred by regulation or internal policy from going short, have actually started launching funds using the 130-30 strategy, and it combines a long-only portfolio with a 30% long, 30% short position, which produces alpha more effectively. Not only does it enable managers to profit from stock moving down as well as up, but it counters the biggest objection to selling short, which is that in the long run, the market tends to move up so that it is better to be fully invested in the market. With a 130-30 strategy, you are effectively 100% exposed to stocks. Hedging options. Another possible reason for using spread betting is to hedge an option position I hold in a quoted company. In the build-up to the exercise date of the options, I would take the view that the share price had reached a price at which I would be happy to sell the shares, but I could not sell as the option had not yet been exercised. I would therefore go short by taking out a spread bet, and on exercise of the option, I would close the spread bet and sell the shares. This gives me a locked-in price. For more information, visit www.financial-spread-betting.com. www.hedgingstrategy.com.